More now on the Wall Street plunge and why it is continuing. Deirdre Bolton joins us. Good evening, Deirdre.
Good evening, Chris. On Wall Street, we saw the fifth day of 500-plus point intraday swings. For the Dow, the fifth day of heavy selling, and it is now down 10% from its recent record high, which means it is officially in a correction. So this sustained selling does make some investors anxious, but to others, they see this return of volatility as long overdue. We had almost an entire decade of stocks moving higher year on year. Strategists telling me the U.S. economy is solid. American corporations are delivering on earnings and sales. We have 17-year low unemployment. We have wage growth for the first time in almost a decade, and corporate America is beating estimates. In fact, in this last quarter, almost 80% of the time. But the higher highs and the lower lows, that is just part of the investing landscape thanks to computer-guided programs. So humans write trading programs to kick in automatically when markets hit certain levels, but in only one part of the market, and I'm just looking at hedge funds, quantitative funds are responsible for almost 30% of all U.S. stock trades, and that is double the amount of about a decade ago. So the bottom line here is that there are more machines in the mix. They process in greater volume with greater speed than humans, and the result is higher volatility. Now, in today's session, the bond market also fell, so you had 10-year Treasury yields up to 4-year highs, and that affects consumers because all borrowing gets more expensive. So mortgage rates, they are already ticking up. 3.95% is what we saw in January. This week, 4.32%, so obviously still historically low levels. But if consumers want to borrow money to buy a house or a car, it is going to cost more, and for corporations, borrowing also more expensive. I know the House and the Senate are voting on that sweeping budget deal that would stave off another shutdown, but it also increases federal spending, of course, over the next 2 years. And some strategists saying this idea of another $300 billion of spending and how we're going to pay for it is another part of the market anxiety. Chris, back to you.
Other than that, everything is great, dude. Thank you.
That's right.